Before we really get into calculating some examples of income tax, there's a couple other details that we need to iron out. First, I have a bunch of formulas up here on the board. The first one we've talked about, the adjusted gross income, is your gross income minus adjustments. Okay, we saw that in the previous video. And we saw that taxable income is this adjusted gross income minus your exemptions and deductions. Okay, and we talked about what the adjustments, the exemptions, and the deductions all are. Okay, now from that amount, your taxable income, you apply a tax rate, and the rate is actually based upon the value of the taxable income from a table. Okay, so table should be appearing over here on the screen. And so the details of the table we'll talk about, but essentially each row lists the percentage that's applied right here. Okay, the percentage that you multiply by. The columns represent different family structures, whether the individual is single, whether they are married but maybe filing separately. So maybe you're a married couple but you're each filing your own separate tax form. Maybe you're married and filing jointly, so you're filing one single tax form for your entire household, or you're what's called a head of household, in which case maybe you're taking care of or supporting other family members like your parents or something if your parents are elderly, or an adult child or something. And so there are some other situations there, but so each of those columns then gets its own tax determination here. So the percentage is based upon those, and it's also based upon the actual income. So within each row, you'll see the amount that the taxable income must be in order to apply that percentage. All right, so for instance, for a single individual who makes between $9,276 to $37,650, they're going to be taxed 15%. Okay, and so on. So you can kind of see how that plays out. So you look down the column, you find your situation, whether you're single or whether you're married, filing jointly, whatever it is. Find your situation, look down the column, find in a cell where your taxable income lands. It's going to be in one of the ranges in that cell, and then you go over to the tax percent on the left side of that table, and that percentage is what you would plug in here for the rate. Okay, so you take your taxable income times the rate, and that will give you your tax calculation. Now that's not your final step, unfortunately. There's one more thing to consider, and that's called your tax credits. Now, some of the money that's deducted, like your adjustments, your exemptions, and your deductions, those are taken off before the rate is applied, which means you only really reduce your tax by a percentage of those, right? Not the full amount. Tax credits are reductions of the full amount. Okay, so I had a tax credit one time because when I built my house, I installed a geothermal heating and cooling system, and the geothermal came with a large tax credit. I believe it was a $10,000 tax credit. Maybe it was $8,000, but I think it was $10,000. Anyway, it was a significant amount, and it was kind of the selling point on going that route with my heating and cooling. And that amount was taken off in its entirety, so I didn't have to figure out what my rate was, if it was 15% or 30%, and then apply it to that and only get that off. No, I get the whole amount taken off. And so tax credits are very beneficial. A lot of times, when you're doing things to your house, like solar energy, different energy credits get applied here. Some education credits get applied here, but tax credits are amounts that are taken off in their entirety. Okay, And so the final income tax, the amount you actually have to pay at the end of the year, is determined based upon your tax calculation minus those tax credits, okay? And then you finally get the amount that you have to pay in. Now what's interesting is you do get some federal income tax taken out of your paychecks. Basically, it's the government saying, we're gonna hold on to some of this money so that we know we get paid. And then at the end of the year, you go through and determine all these other things, your adjustments, exemptions, deductions, the rate, and your tax credits, and then you come up with a new value. And if the amount that the government has taken from your paychecks exceeds this final income tax, then you get money back at the end of the year. If the amount of money the government has withdrawn from your paychecks is less than your income tax, is less than what you calculate you owe, then you actually have to pay more at the end of the year. Okay, so now the goal is to get these subtractions as high as possible so that you can get some money back at the end of the year. That doesn't always work out that way. Okay. All right, so in the next couple of videos, we'll look at examples of how to actually calculate these things for a given situation.